Hey everyone, welcome back to Corporate Decoder. We're diving into Noble Roman's latest annual report. I know what you're thinking, pizza. How exciting can that be? Well, let's just say there might be more dough involved than just what they use for the crust and some potentially spicy drama. This report gives us a peek into how the pizza chain is doing. We'll look at the numbers, see where they're making money, and uncover some of the risks they're facing. It's not just about pizza, it's about business strategy, financial health, and even a little bit of corporate squabbling forward. If you like getting the real story from company reports, make sure to subscribe. We also have a Discord community linked in the description below. Join us and talk about markets. First off, the report tells us Noble Romans had about 22 million shares of common stock out there as of May of this year. That's how many pieces of the company are floating around in the market. Now, this is their annual report called a 10K. It's basically a yearly checkup for investors. The report says it covers the fiscal year that ended December 31, 2024. So all the numbers we're going to talk about are from last year. Alright, let's dive into how Noble Romans actually makes money. The report divides their revenue into a few key areas. They own some restaurants themselves. These are called company-owned restaurants. They also franchise their brand, basically letting other people open Noble Romans restaurants using their name and recipes. First, their company-owned restaurants made about $8.6 million. So Noble Romans runs a couple of pizza places directly, and that gives them some revenue. Then comes the franchising side. They earned about $5.5 million from selling franchises, collecting royalties and fees from those franchise locations. Axe franchising is where the growth is with Noble Romans. They've been focusing on selling franchises for non-traditional locations. Think of it as a Noble Romans Express inside a gas station or a hospital. They even have one company-owned restaurant in a hospital, and that made almost $1 million. If we add it all up, their total revenue for the year was roughly $15 million. Count them now, that is the income. But how much did they spend and what did they earn? Here's where it gets a little less appetizing. They actually ended up with a tiny net loss of about $3,000. Yeah, after all that pizza, all that effort, they barely broke even. It's important to note that in the previous year, they had a net income of over $1.4 million, but that included a significant one-time refund under the Employee Retention Credit Program during the pandemic. This is where the report breaks down the money coming in and where it went. Let's start with the company-owned craft pizza and pub locations. Remember those craft pizza and pubs that make the $8.6 million in revenue? Well, after paying for ingredients, staff, rent, and all the other expenses, they only had a margin contribution, kind of like a profit, of about 9%. That means for every dollar they sold, they kept about 9 cents. Not amazing. The franchising side is much more profitable. Their margin contribution here is about 69%, meaning for every dollar they bring in from franchising, they keep almost 70 cents. This proves their pivot to franchising. However, the hospital venue isn't doing so hot. It actually operated at a loss of almost 5% due to them moving the retail operation while the hospital was being remodeled. Digging deeper, some corporate expenses are noteworthy. Depreciation was at about $500,000, pretty normal considering all the locations they have. But general and administrative expenses went up a lot, hitting to $6 million. These usually include salaries for the main office, legal fees, and other overhead costs. There's also the interest expense at $1.6 million. This is what they pay on their loans, which are pretty substantial, meaning the business has a significant debt. Interestingly, the cost of fighting against an activist shareholder went way down from $168,000 to just $35,000. Seems like that particular battle cooled off a bit, although you may want to pay attention to this to see if there are more flare-ups. Of that debt, $6.5 million is in the form of a senior secured promissory note, and $575,000 is in the form of convertible, subordinated, unsecured promissory notes. Long story short, they've got a lot of debt and they issued warrants, which are like options that allow certain lenders to buy a large chunk of the company's stock at a very low price. That could dilute existing shareholders, basically make each share worth less if those warrants are exercised. This is the risk with taking on large amount of debt, and you should watch this carefully. The report mentions BT Brands, a company that runs about 18 restaurants, and its CEO, Gary Coppard, BT Brands tried to get Copperwood elected to Noble Romans bought it, Noble Romans blocked it, and BT Brands sued. The court didn't take their side, and BT Brands dropped the lawsuit, but not before Noble Romans spent over $200 of Dolan to be going through how to lawsuit, but not before Noble Romans spent over $200,000 defending themselves. The board is determined BT Brands is not acting in the best interest of all shareholders, so keep your eyes peeled for more drama there. Now for something you don't often think about when it comes to pizza, cybersecurity. Noble Romans handles customer data, credit card info, employee details, and they also use third parties for online ordering and deliveries. So hacking and leaks are a real risk. They're trying to keep everything safe with security measures, hardware, software, the works, but they also admit that no security is perfect, and because they rely on other companies, they depend on those other companies too. The pizza business is a battlefield. They're up against huge national chains and smaller local joints, and they compete on convenience, price, quality, service, the whole shebang. In the non-traditional locations, they're trying to win by having better quality ingredients, simple operations, and lower labor costs. A big chunk of their money comes from franchising, but they depend on those franchisees to run their restaurants well, report accurate sales, and follow the rules. If the franchisees mess up, it hurts the whole brand, and their revenue goes down too. Speaking of rules, there are tons of them. Franchise laws, health codes, safety regulations, labor laws, environmental rules. If they or their franchisees don't follow these rules, it could lead to fines or make it harder to open new locations. Finally, the report mentions where you can find more information, but those are just normal links. Excerpt breakdown of Noble Romans' latest filing. So what's the story here? Noble Romans is in a tough spot. They're focusing on non-traditional franchising, which is smart because it's more profitable than running their own restaurants. However, their debt is a significant burden, and any more drama from activist shareholders could distract them. The low stock valuation isn't helping either. Their direction seems sensible, but in reality they will need to navigate the competition, and any missteps with their security or finances could have big consequences. The fact that they barely made a profit is something to watch closely. I feel that pivot to franchising can be a good idea, but there is definitely a risk with debt, and it will be something to monitor in the next reports. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.